Well, we are going to go ahead and continue our lecture here among entrepreneurship, launching new ventures, among other things, as well as some different forms of ownership. And for this lecture, we're going to talk about some of the different types of business ownership that you can get into if you do ever get to the point to where you're going to start a new business. There are multiple different types of forms of ownership that you can utilize. So we're going to discuss those over the course of the next few slides here and go over some of the advantages as well as disadvantages of each. And obviously, every one particular form has its strong suits, mainly its purposes and what it's geared towards, but they also have some of the areas in which they are lacking and kind of fall short. So just to go over a few of those, we have sole proprietorships. Sole proprietorships are owned and operated by one particular person. If you were to operate a business and fill out a DBA, a doing business as, and get your tax ID number and get that filed, you would be essentially a sole proprietor. Okay, and there are numerous advantages and disadvantages of a sole proprietorship that we'll go over in subsequent slides here. You can also have a partnership. A partnership is very similar to a sole proprietorship. The only difference is that there's more than one person, so there is some type of shared ownership between two people. Next, you can have corporations. Corporations, we all see that we go through the filing processes in which we can actually become a corporation. There are a number of different types of corporations. There are LLCs, S corporations, to name a few. But we will go over some of the advantages and disadvantages of corporations and what their primary purpose is. Now, in terms of a choice of ownership, it's important that as an entrepreneur, your decision to choose either a sole proprietorship, a partnership, or a corporation is based upon a number of different important factors. The first of which is your desire for control. Depending on the different type of ownership, you may have to give up more control. A sole proprietor, you have the most control because you're the only person that's in charge and running your business. So the decisions that you make and the actions that you take are your own. In a partnership, you're giving up a little bit of control because you do have another person involved. In a corporation, you're giving up a lot of control because you typically have a board of directors and different people who all have opinions and says in ultimately what happens with your company. Depending upon the type of ownership that you take, you'll have difficulties or maybe an easier time getting financing. So that also plays a role. And there also is the degree to which your chosen form of ownership is appropriate based upon the industry in which you reside in. So let's look more specifically at sole proprietorships. Let's examine these and take a look at some of the advantages and some of the disadvantages of this particular form of ownership. The primary advantage for a sole proprietorship is freedom. The rules that you make and the rules that are followed are basically at the discretion of the sole proprietor. So you don't have to necessarily adhere to anyone else's ways of doing business or anyone else's practices because you're controlling the direction of the company. So that is definitely one advantage, is this idea of freedom. They also are very, very easy to form, very simple. There's very low startup costs that go into forming a sole proprietorship. Like I said, you have to file paperwork for a DBA, which is a doing business as. You have to file for a tax ID for tax purposes. Other than that, there's not really a whole lot that goes into forming a sole proprietorship. It's as easy as that, and it really is a matter of a couple of quick phone calls. So they're very, very simple to form in comparison to some of these other forms of ownership. Next thing is low startup costs. There's very little that goes into actually the paperwork. Usually there are some filing fees and those types of things. Other than that, though, there's not a whole lot of legality in terms of paperwork that you do have to go through to actually start a sole proprietorship. There also can be tax benefits as well. Income and expenses for a sole proprietorship are taxed at your own personal rate. So depending upon what that is, that may allow you certain benefits with regard to taxes. Now, whenever I always say the term taxes, I always recommend speaking with obviously a qualified accountant and someone that is involved in the actual ownership piece in terms of how that has implications for your business and your personal tax income. But one of the advantages, of course, is being able to have that income pass through to your own, and you can take advantage of different deductions and maybe a lower tax rate. And the next is the formation of cooperatives. Cooperatives, as we'll discuss later on in the lecture, are a combination of sole proprietorships, but also give you some more financial resources because you're forming almost a like a joint venture between multiple different types of businesses. And although you're not forming specifically with one another, you're not creating a new entity, you essentially are assisting one another in how you operate, so to speak. All right, now, unfortunately, there are several disadvantages associated with sole proprietorships as well. The first of which, and probably the most prominent, is what's known as limited liability. And what that means is that you, as the owner, are responsible for all of the debts. Because of the fact that you don't have any type of protection in the forms of legal protection, if your company essentially gets sued, there is no company. It is you. And so all of your personal belongings, your home, cars, any type of assets that you have could be pursued in an actual lawsuit. So that is definitely a primary disadvantage for a sole proprietorship, is this idea that if you get sued for your company does something wrong and get sued for whatever reason, your personal belongings can essentially be liquidated to meet the requirements of that lawsuit, or to fulfill the requirements of that lawsuit, I should say. The next thing is you have limited resources. If you're a sole proprietorship, obviously the advantage is being alone and having the freedom and the flexibility to determine the outcome or the direction of your company. But that also is a disadvantage, because you and yourself, you don't have as many resources. And this isn't necessarily just have to do with money. Most time we think of resources as money. Resources also in terms of skill sets, right? There are very few of us that have the skill sets necessary to really operate a business on our own. There are multiple different skill sets that are needed. Everything from a background in accounting to maybe a finance background to a marketing background to an understanding of operations to an understanding of law. And few of us have a solid grasp of all of these different subjects, enough to actually be able to effectively run a company as a sole proprietor. So not only the lack of funds, but also the lack of skill sets is implied when I say limited resources. Next is limited fundraising capability, and this kind of goes in conjunction with limited resources. Most venture capitalists, most banks, they don't feel very comfortable putting their stock into one person. And that's essentially what they're doing, right? If they agree to give you money to actually run a company, if they're making an investment in you, they're essentially betting on you. And I don't know about you, but I would feel more comfortable knowing there's at least a couple of people involved, because if one person doesn't know what they're talking about, the chances are that maybe the two other ones should know something or should say something to play devil's advocate. And so you have the ability there, if you have more than one person, to really take advantage of multiple different perspectives, multiple different skill sets. So I, as an investor, would be more comfortable with multiple people involved for that very reason, because you're not going to find one person that's going to have a good complement of all of these skill sets necessarily. And lastly, the last disadvantage is a lack of continuity. Once the sole proprietor, the person running the business in a sole proprietorship, if they were to die for whatever reason, the sole proprietorship ends. There is no continuation, so to speak, because it's continued based upon that person being in existence. So a lack of continuity is another primary disadvantage. Now let's take a look at partnerships. Partnerships, as we know, are very, very similar to sole proprietorships, the only difference being there's more than one person. So obviously, if you have more than one person, a primary advantage would be more talent and money. If I have a partnership, not only is it just my money I'm putting at stake, but I also have someone else in the mix. And it also means that person is bringing a certain complement of skills to the table as well, which we can leverage in operating our business. You also have more fundraising capability with a partnership than you do a sole proprietorship. And I mentioned this before, if I'm an investor, if I'm a bank and I'm giving you a loan or some type of investment, I feel more comfortable having multiple people involved, because once again, you have more talent. There's a greater complement of skills there, which can lead to the success of the business, or at least the higher probability of the success of the business as well. Like sole proprietorships, partnerships are relatively easy to form. It's a very similar format. One of the things that you will want to do, though, is obviously have some type of formal document indicating how revenues are split. If it's the 50-50 situation, or if it's dependent upon the investment into the partnership, how do you transfer ownership if one partner wants to leave? or disband the partnership, what happens. You want to consider those things as well. You essentially want to iron out formally on a written document, that way, because people's perceptions of what happens can change. You want it written out in terms of how the business operates, how you disperse revenues, all those different types of things. You want to leave as little the chance as possible to help you later on. And there also can be limited liability for limited partners. We'll discuss in the next slide what a limited liability partnership is. For a general partnership, though, very similar, there is unlimited liability similar to a sole proprietorship. And obviously being the primary disadvantage. If you're a general partner, you have unlimited liability. Once again, if there's any type of lawsuit, in order to fulfill the requirements of that lawsuit, they can pursue your personal assets, which can be extremely problematic. Next can be the disagreement amongst partners. And this is where it's important to have an actual written document available that kind of irons out how you're going to disperse revenues, what happens when someone leaves. Have the conversations up front when everyone isn't emotionally charged as what happens when you get in those situations. It's good to have a plan. And next, a lack of continuity as well, similar to a sole proprietorship, because it's dependent upon the actual owners. If any one of them dies or for whatever reason decides they do not want to continue in the partnership, then the partnership ceases to exist at that point. Now, one of the things that I mentioned is this concept of a general versus a limited partnership. And a limited partnership is very similar to a general partnership, only you have what are called limited partners. And a limited partner invests money into the partnership but isn't liable for the debts. So if I give a $10,000 investment into a partnership and I'm a limited partner, the maximum amount that I can lose is my $10,000 investment. For whatever reason, if the business fails and we have to liquidate and pay off debts, I cannot be pursued for my own for the debt of the business. I am liable only for my investment. So my $10,000 might be gone and I have to live with that, but I can't be pursued personally if I'm a limited partner. Now, the general partners are usually the ones that make the decisions. As a limited partner, I'm limited in multiple respects, one in which is liability. The other is my voting rights, essentially. I have less of a voice because I'm not taking as much risk, right? I'm giving the investment in hopes of getting something in return, but if everything goes south and the company goes under, I'm only liable for my investment. So a general partner, you have a little more flexibility, but on the other end, you have a much more likelihood of having to risk it all and potentially leveraging personal assets. Now, you can also have a master limited partnership. This involves actually selling shares. Now, it's not like selling shares on the open market, so to speak, but it can be very similar. So you wouldn't necessarily list them on the NASDAQ or any of these other types of exchanges or market exchanges, but you would sell shares to people. And essentially that would give them the rights to certain profits, that would give them possibly certain voting rights as well. These are less common, but it's still obviously an opportunity or an avenue for business ownership. Now let's take a look at cooperatives. I alluded to this before in a few slides prior, but a cooperative combines the freedom of a sole proprietorship with the financial power of a corporation, because what you're doing is you're grouping sole proprietorships and partnerships together to work for a common benefit. Cooperatives are very common in agriculture. We've seen cooperatives for organic foods, and those are very prevalent in the Central Valley, where multiple farms get together with one another for the purpose of offering different types of, or an array of agricultural products and different vegetables and fruits and different things. And so they can reach a broader market because they're offering a package of goods that's different just from one particular agricultural product. So cooperatives offer that benefit because alone, by ourselves, we have very limited power. But if we get together with a bunch of other sole proprietorships and partnerships, then we can work towards a common good and advance all of our unique interests. Next, we have corporations. Corporations, of course, have legal status as separate entities, meaning that you go through legal proceedings and actually file paperwork to have a separate entity, and that provides you with certain different things. Now, corporations, in terms of some characteristics, before we get to the positives and the negatives, corporations can be large or small. Most people, when they think of the word corporation, they think of this very large company that has lots of employees and lots of assets and does lots of money or lots of revenues, which isn't necessarily the case. A corporation is just a form of business ownership. It doesn't imply size of a particular company. Okay? Now, corporations, because they're a separate entity, they can be sued, and they also can sue others. So your corporation specifically can be sued, which is good because it does protect you from liability. Corporations, like separate entities and citizens essentially, can buy, hold, and sell property. And so you have a lot of businesses that would hold property under the name of the corporation and not the individual owners of that corporation. Corporations can obviously make and sell products as well. Just like individuals can make and sell products, corporations can as well. So you see that corporations have a lot of the same characteristics as we do as individuals as well. Once again, they can commit crimes and be punished for them. Same types of things that we can as individuals. And the last thing that I mentioned before is they have limited liability for the individuals who form them. So I, as maybe someone involved in the corporation, although I might put an investment into that corporation, if the corporation ceases to exist at some point and has to pay off debts, I cannot be liable for my own personal assets. They won't go after that because I'm protected by the status of a corporation. So let's review some of the advantages of corporations, and these are going to be a little bit kind of reiterated from before, since I mentioned a few of these prior. The primary advantage of a corporation over some of these different forms of ownership is the fact that you get limited liability for the owners, meaning there's a limited financial responsibility. You're limited by your investment only. The amount of money that you put into the corporation is simply what you can be liable for. You may lose your investment, but all of your personal assets are safe. Another advantage of a corporation is continuity. If the owners or board members, whomever is involved in running the corporation, die, the corporation still, because it's a separate entity, is not tied to their livelihood. So it continues to exist. So for continuity purposes, that is a very good advantage. Corporations also have stronger fundraising capabilities. When you have a corporation, you're essentially viewed as being more legitimate, as being more credible, because you've gone through proper channels to set up an actual company. And so the mentality is that you're more serious, and that translates to your ability to fundraise. As we mentioned before, it's very easy to set up a sole proprietorship and a partnership, and although that is good, there sometimes is a negative connotation to that, or negative view in terms of society, in that maybe you're just trying this out, maybe you're just testing the water. Are you really all in? Is this something kind of a side job? Whereas a corporation takes a little bit more time, effort, and money and resources to start. So the stance is maybe they're more serious. This is maybe a legitimate business, so to speak. But also in corporations, you typically have to have different bylaws and things that you abide by. And so the idea is, if you create those things, you have multiple people involved. Once again, multiple skill sets, increasing the success of the company. Now, there are several disadvantages of corporations as well. First of which is what's called double taxation. If you've taken any type of finance or possibly accounting course, you'll be familiar with this concept of double taxation. Double taxation essentially is the idea that when a company sells goods and services, it earns revenues from those, okay? And then obviously pays expenses and those types of things, and that gets whittled down to its net income, or profits essentially. And then if a corporation decides to pay dividends, which is a payment made on a per share basis to its shareholders, now I, as a shareholder, have to claim that as income, okay? So primary example, I have several shares in Walmart, for example. Walmart, obviously, we know is the largest retailer, at least physical retailer, in the world. And Walmart pays dividends on a quarterly basis. So depending on how many shares that you have, Walmart will pay a %, usually it's a percentage dividend of its income, to its shareholders, just as a reward of investing in that particular company. But when you get those dividends, you now have to claim them as income on your tax returns. So the dividends that I receive from my Walmart stock, come time to file for taxes, I now have to claim that as income. And so it's taxed again, hence the term double taxation. So that can be extremely problematic. There's a lot of talk about that potentially going away, because that is kind of an issue in terms of fostering a business environment and pro-business environment. And if we're going to try to jumpstart the economy and continue to go and grow in an economic growth, is that an issue that's preventing us from growing? Maybe, maybe not. But that is a little bit of a talk about that maybe going away. Who knows? Next disadvantage is fluid control, meaning that you can have multiple different people involved. And so there's not necessarily one person directly in charge, and that can have some difficulty there, especially if somebody leaves, if somebody that was originally in charge. The corporation continues to exist, but in terms of who's controlling it, that changes. So you can have some issues there. There was a lot of concern over Apple once Steve Jobs essentially left his post as CEO and just became, or was, for that matter, board chairman before he unfortunately passed away. There was some concern if Apple can continue to develop and create these types of innovative products that were created essentially by him, that were his vision, so to speak. And so that was a concern at that point in time. And when Steve Jobs stepped down, the stock price for Apple took a dive, because that was the primary concern. Could Apple sustain this without their lead visionary at the helm? And next, as form of a disadvantage for corporations, is they can be complicated and expensive to form. They're not similar to partnerships and sole proprietorships. You can't sign a couple forms, make a couple phone calls, and essentially have that form of ownership. This takes a little more legwork. Typically when you form corporations, you have attorneys involved, and so it's complicated. Obviously, whenever you put attorneys in the mix, you're adding to expenses, and so that is another disadvantage. Now, in terms of managing corporations, there's different things that you actually have to do to manage a corporation, and a lot of these entail what's known as corporate governance. Okay. The main idea behind corporate governance is we're essentially trying to determine who makes the decisions and who is accountable. Whenever the word governance is used, it's referencing accountability. We're trying to find out, how do we determine who does what, when, where, and why, so to speak. Okay? And these are typically established by a firm's bylaws. And there's three primary bodies that are basically created. First, you have stockholders, maybe shareholders. Those terms are used interchangeably. As a stockholder or a shareholder, I hold stock or shares of a company. Okay, so a company essentially divides its ownership into pieces and then sells them in the form of stocks to get money, which is referred to as equity. The bylaws also establish a board of directors. A board of directors is elected by the stockholders, and they're supposed to be overseeing corporate management. So the board is designed to basically express the interests of the stockholders or shareholders. They're supposed to represent the stockholders and the shareholders. Now, the board of directors is not involved in the day-to-day decision making. They're more of monthly meetings, oversight over a long period of time, generally involved in some of the long overarching strategies that take place over multiple years. So they're not involved in the day-to-day. That is left for the corporate officers. The corporate officers are hired by the board of directors, so their job is to essentially carry out the day-to-day tasks, so to speak, obviously with board oversight. So that's essentially how the structure would work. Now, I mentioned this before, but as owners of a corporation, we get what's called stock. And stock, although we don't publish an actual tangible certificate like you're seeing on your screen here, we keep track of these things digitally now. And the reason for that is because you have day traders who jump in and out of stocks over the course of a day, and so it wouldn't make sense to print an actual certificate representing you hold so many shares if you sell it by 4 p.m. So we don't issue tangible certificates. I know that kind of unfortunately is a little bit of a letdown for some people because they want to hold something and it's tangible and I have a percentage of ownership in a company. It's all kept tracked in a digital book essentially. But a stock is a share of ownership, and a company has to decide how many or what percentage of ownership to give up. And typically most companies like to give up less than a majority so they still can control the majority decision, so that regardless if everyone disagrees, I have majority ownership, so what I say goes. The next is dividends, which are the profits distributed among stockholders. One thing to note is not all companies pay dividends. Okay, it's on a case-by-case basis. Typically, companies that pay dividends, though, are viewed as more stable companies. They're your blue chip stocks. They've been around for quite some time. and they maybe are not growing or appreciating in their share price as much, so they want to reward investors another way in the term of dispersing dividends. Now, most technology companies do not pay dividends because technology obviously is a very growing industry, and so the idea is instead of paying this money to shareholders, we're going to take that and we're going to reinvest that into our company, which is what's called retained earnings. And we're going to use that towards research and development or different projects that we're working on because we feel like we can use that money better than just paying that to our shareholders. And the way that we're going to reward people is based upon producing successful products, those products selling well, and then our share price is ultimately increasing when we release statements for positive earnings. So let's look at a couple of the different special issues related to corporate ownership. These are less common that you can see also, joint ventures and strategic alliances. A strategic alliance is when you have two or more organizations that get together to collaborate on a specific project for mutual gain. Okay? And so the idea behind this is we're forming for just a brief moment in time. This isn't something that's designed to be sustainable. We're working together for a specific project, so to speak. And then once this project is over, then we will essentially not work together anymore. So you can form a strategic alliance. You also have partnership or joint ventures, A joint venture is when you have partners that share ownership in a new enterprise. Okay? So you're actually creating a new company. So two companies get together and we collectively want to create a new company. Okay? So a strategic alliance, you're not creating anything new, you're still coming together and working together as two individual units. For a long time, Intel had a lot of strategic alliances with different computer manufacturers, and you saw when you purchased a computer or a laptop, you'd see a little sticker for Intel inside. So it was kind of this alliance between the two companies to market actually together, so that the computer manufacturer would get the benefit of knowing that they have, or the consumer would see that there's the Intel sticker, so they have that recognition, and then also Intel gets the benefit of having their products in multiple different computers as well. You also have employee stock ownership plans. Okay? Employee stock ownership plans essentially allow employees to own shares of a company, typically through trusts that are established, but it gives them the ability to own percentage of the company that they work for. And this is becoming increasingly popular because you want the people that work for you, you want their success to be tied to the success of the company. If all I get is an hourly wage, then I may not care if the company does good or bad. Obviously, to a certain extent, it has to do good because we want it to be obviously in existence. But I may not try as hard, right? Because I still get my hourly wage, and so that is fine. But if I have an extra incentive to do well in the form of stock, then that may be an extra incentive for me to actually go above and beyond. Okay? And next you have institutional investors. Institutional investors control enormous amounts of money. They're typically pension funds, large mutual funds, and so they purchase stocks in a significant amount, not like you or I, we're purchasing a few here and there. You know, what we do in terms of trading doesn't even make a blip on the radar of the indexes in terms of movement. But institutional investors, they control multiple millions of dollars in and out of certain stocks. And obviously they don't move in and out very quickly. They typically hold them for a period of time. But they are a large player. If you were to look up on Yahoo Finance or Google Finance, and if you were to look up a particular stock, the 10 largest holders of that stock are going to be institutional investors or board members or chief executives in that particular company. And that's another reason why a lot of CEOs now are paid based on stock, because we as a board, we want them to be interested in the company's success. We don't want them just earning multiple millions of dollars in a salary and managing the company in the tank. So you're seeing a connect between ultimately the stock price and the success of a CEO. Even some CEOs for a long time, I know Eric Schmidt, who used to be CEO of Google before Larry Page took over. He was paid $1 a year. That was his annual salary. So he did not make a salary. He was paid all in stock options. And obviously, if the company did well, the stock price appreciated and made him a significant amount of money. If the company did not do well, then the stock price depreciated and he did not make any money. And so that's the way that you tie the interests of employees and chief executives to the success of the company. All right, lastly, we're going to finish up here by looking at some of the different issues with corporate ownership. We're going to talk a little bit about mergers, acquisitions, divestitures, and spin-offs. And you may have seen these in certain circles before, fairly common terminology. A merger is when two firms combine to create an entirely new company. Okay, so maybe one firm comes together and they both create a new company, a new name, maybe a combination of those two names. That could be an actual merger. You also have an acquisition. This is a straight purchase. One company purchases another. For example, Google purchased Motorola Mobility for, I believe, $12 billion not too long ago. And so that was an acquisition. Google absorbed Motorola into its existing portfolio of companies that it holds. Google didn't necessarily change its name, and most people don't even know the acquisition took place. Divestiture is another form of, basically you're getting out of a particular industry. A firm is selling off one or more of its business units. There was a lot of controversy over Netflix not too long ago announced that it was going to be spinning off or getting rid of its DVD business, right? Netflix has come out and said that we want to invest in digital technology because we believe that is where we're going in terms of an industry, and we don't think that necessarily DVDs and mail and how it gets more expensive to obviously mail everything now and then. We're viewing that as a dying industry. So we want to put money into this digital business. And so it announced that it was going to get out of the DVD business. It was going to basically establish a separate company and just sell it entirely. And there was a lot of backfire that came from that, right? Their stock price took a nosedive for quite a while, and it's just recently started to kind of trickle back to the point to where it was before that actually took place. But divestiture, by going through a divestiture, you're essentially selling an entire business unit. HP talked about trying to get out of the personal computing business. Although they're the largest player in the market for that, they viewed it as being a dying industry. They wanted to kind of go into more of the tablet arena, so to speak. And obviously they've kind of shifted gears since then, since Lee Apotheker is no longer CEO and Meg Whitman is now the CEO. But that is just one example of a divestiture. The next thing is you have a spin-off. A spin-off is typically when you basically just take a business unit and you actually create a new company. You spin it off essentially into its own company. ConocoPhillips, one of the largest oil refiners in the world for that matter, announced that it was going to be spinning off its oil refinery business because of the fact that it's not as attractive as an investment as some of its other different businesses that it holds. And so the mentality was, if we spin this off into a separate company, we're going to give investors an opportunity for maybe a more conservative return on their investment. And then we'll have the rest of the company, which will be in these, acquiring different technologies and different natural resources and finding different ways that we can use renewable energy. That'll be maybe a more risky investment that'll maybe entice some of those investors who are okay with a lot of risk. So obviously you'll see a lot of these different things in the news. Mergers and acquisitions for the most part have been fairly quiet for some time, although we have seen a couple of larger ones in the not so distant or not so recent memory. But the divestitures and spin-offs you don't see as much. So just a couple of examples of different things that you can do in corporate ownership. All right, that concludes the two-part lecture here on entrepreneurship, business ventures, as well as corporate ownership. If you have any questions, please let me know. Otherwise, have a great week, everyone.